Welcome to Uncovering Trusts, a podcast by the Edison Group, a content-led IR business integrating analyst content, digital targeting, and investor engagement. Each episode will uncover the distinct features and latest developments of a selected listed investment company. So tune in to find interesting investment ideas and to stay on top of what's happening in the investment company sector. I'm your host, Will Manuel, and today I'm joined by Milosz Papst, Director of Investment Company Content, and Jyoti Prakash, Healthcare Analyst at the Edison Group, who will talk about Edison's recent thematic report on healthcare-focused investment trusts. Jyoti, Milosz, thanks for joining us today.
Thanks for having me.
Thanks for having us.
Lovely to have you here. So, Milosz, why have you decided to look into the healthcare theme now?
Well, we believe that following a turbulent period in recent years, the healthcare sector, and in particular small and mid-cap biotech companies, are now primed for a turnaround. The sector remains fundamentally strong, and the downturn after 2021 led to rightsizing and more realistic valuations, which potentially offer an attractive entry point. This is coupled with continued high level of innovation, a looming patent cliff for big pharma, an uptick in IPO and M&A activity, as well as technology-driven advancements. All this creates fertile ground for a re-rating of the sector on the back of the recent reversal in the interest rate cycle, as well as the conclusion of the US presidential elections. In this context, we discussed in our thematic piece the role and positioning of specialist healthcare investment companies as a way of gaining exposure to the sector while managing the downside risk.
Right. So, can we take a step back? And before we delve into the current market environment, can you just recap what happened in the biotech and healthcare sector since the outbreak of the COVID-19 pandemic?
Sure, I agree it is helpful to briefly discuss the events leading up to this point. While the COVID 19 pandemic initially brought activity across several sectors to a standstill, healthcare was the contrarian, with both sector focused investors and generalists shifting attention to the space, driven by the positive sentiment towards the sector's curative efforts. This trend in particular was led by biotech, assisted by the successful development of mRNA vaccines for COVID 19. The biotech bull run was further driven by the monetary easing and fiscal stimulus at that time. As a result, the S&P Biotech Index rose over 250% between March 2020 and February 2021, driving valuations to what many believe were untenable levels, peaking in February 2021 at the height of the pandemic. As expected, there was a corresponding surge in IPO and M&A activity across the sector.
Right, thank you. But then the market turned after the first half of 2021, right?
Yes, exactly. As interest rates rose sharply to curb inflation, the valuations of high risk, long duration assets, such as biotech companies, especially emerging biotech, were subject to a sharp correction, with the S&P Biotech Index down by more than 65% against the broader S&P 500 between February 2021 and November 2023. We also saw a wave of bankruptcies and restructuring and a visible decline in funding in the private markets. The impact of this capital crunch was particularly severe for capital-intensive development stage biotechs. This is illustrated by the strong fall of the SPDR S&P Biotech ETF index, which is a proxy for small-cap biotech performance given its equal weight composition compared with the capitalization weight Nasdaq Biotech Index.
Okay, thanks. And so I understand that despite this significant derating, fundamentals across the sector are strong. Can you shed some light on the current level of innovation across the industry?
Of course, the high level of innovation is evident in the record number of FDA approvals, 67 in 2023, with 36% of the approved chemical based drugs being described as first in class. That is, drugs with mechanisms of action differing from those already available on the market. In 2024 to date, the FDA has approved around 50 new drugs, including 13 biologics. Some of the notable drug approvals have been CAR-XT for schizophrenia, developed by Karuna Therapeutics, which was acquired by Bristol Myers Squibb in late 2023 for $14 billion, as well as Eli Lilly's drug donanemab for Alzheimer's disease and Acceleron Pharma's drug for pulmonary arterial hypertension. I would also note that two of these three drug approvals I've just highlighted were developed by smaller biotechs before they were acquired by big pharma. And according to Vital Transformation, a healthcare research consultancy, 55% of the drugs approved by the FDA between 2011 and 2020 in the US were developed by smaller biotechs.
Right, that's very interesting. So I understand that the strong innovation among emerging biotech should encourage big pharma to ramp up M&A and licensing deals.
Correct, but it's not only the level of innovation, but also the upcoming patent cliff and corresponding sales at risk that many big pharma companies are facing or have recently faced for their blockbuster drugs. In our thematic piece, we focused on 12 major drugs for which we see sales at risk of around $150 billion. With some estimates we've seen for a wider selection of drugs at more than $200 billion. Here, I would note that patent cliffs form part of natural cycles in the healthcare sector every 10 to 15 years. And the last notable set of patent cliffs was around 2010. Now, the majority of the selected 12 drugs we looked at are biologics rather than small molecule drugs. The latter typically face steeper patent cliffs due to the ease with which manufacturers can synthesize generic products, whereas biologics come up against biosimilars, which are more challenging to manufacture and hence are not as straightforward to substitute from a prescribing perspective. Moreover, particularly in the US, biosimilar entry tends to be challenged with patent litigations from the original drug manufacturers, with Humira being a good example. Still, we believe that this will be a challenging period for big pharma companies to navigate, and revenues will need to be replenished to offset the patent cliffs, driving M&A and licensing deals across the sector.
Right, that's helpful. So how do the healthcare-focused investment companies fit into this theme?
Well, the biotech sector's scope, idiosyncrasies, and technical complexities make successful stock picking difficult for generalist investors. This is particularly important given the binary outcome of investment cases for many individual biotech companies, tied, for instance, to their clinical trial results. We believe that healthcare-focused investment companies with their broad portfolios, varied exposure, and experienced managers and analyst teams with strong finance and science backgrounds offer an appealing alternative to direct investment in individual biotechs for both specialist and generalist investors. Importantly, the healthcare sector is vast and encompasses broad subsectors such as pharmaceuticals, biotech, and medtech, each of which is further broken down into various focus areas at different stages of development. Now, while the cash-rich commercial stage larger pharma space typically appeals to value investors seeking capital appreciation and a steady income stream in the form of dividends, biotech investing normally offers more upside potential in exchange for more risk. Now, healthcare-focused investment companies typically have specific investment policies based on how their portfolios are tailored, ranging from more diversified plays to those focused solely on emerging biotech, which provides a platform for all risk appetites. In our research note, we provide an overview of 12 such investment companies, including their investment remit, portfolio diversification, historical performance, as well as shareholder return policies. All these investment companies trade at discounts wider than their historical average.
Perfect, thank you, Milosz. Before we conclude, can you maybe tell us about the most promising therapeutic areas at present?
Sure. I would first highlight oncology, which remains the largest segment in the pharma market with a 26% market share, according to Evaluate Pharma. It is also the fastest growing segment, with sales projected to increase by around $640 billion between 2021 to 2028. I would also highlight an emerging area of innovative new technologies that aim to improve on the more traditional chemotherapy approaches and create more beneficial outcomes for patients. These include, but are not limited to, antibody drug conjugates, bispecifics, cancer vaccines, and radiopharmaceutical drugs. Neurological conditions is also an expanding space within healthcare, with recent headlines covering various components of the segments, most notably Alzheimer's disease. As I've already mentioned, Eli Lilly's drug was approved by the FDA in July 2024, joining Biogen's Leqembi in a new wave of treatments for the condition. Now, moving from neurodegenerative conditions to neuropsychiatry, September 2024 saw the FDA approval of Karuna Therapeutics CAR-XT. The drug has a novel mechanism of action for schizophrenia, reviving what has been a relatively stagnant field since the 1950s. With neurology being a complicated segment of drug discovery with high levels of complexity, we view it as a landscape ripe for clinical innovation, reflected in the rate of advancements in the last year alone. Finally, we cannot forget about obesity, headlined by the impressive performances of Novo Nordisk and Eli Lilly, underpinned by revenues from the new GLP-1 agonist treatments that have rapidly become well-known names, Wegovy and Zepbound in particular. Obesity is highly lucrative, with the total market size projected to reach around $130 billion by 2028. While the current landscape is dominated by the two big pharma players, there is ample opportunity for innovation in the space. There are over 100 candidates in clinical trials for obesity, and while the most advanced programs are based on GLP-1 agonist, the focus areas for innovation also include associated targets such as improving effectiveness of the drugs, minimizing side effects such as nausea, vomiting, and loss of muscle mass, which is seen with the currently approved GLP-1s, optimizing dosing and administration regimes, as well as addressing the conditions associated with obesity, in particular cardiovascular and renal conditions.
That's interesting. And finally, can you shed some light on the technological advancements in the sector?
Yes, with pleasure. An important advancement has been the significant decline in the cost of genome sequencing. A combination of cheap genetic information and the foundation of new modalities, that is, therapeutic techniques, to address disease should be a powerful combination. I also think that AI and machine learning cannot be ignored in transforming the healthcare sector and have the potential to offer many benefits which may be utilized across the entire healthcare landscape, from earlier stage drug development, such as accelerated target identification efforts, through to practicing medicine.
Great. So thank you very much, both of you. You've been listening to Uncovering Trusts, a podcast by the Edison Group. I'd encourage you to explore our recent thematic healthcare piece that we've been discussing to learn more about the sector and the 12 healthcare trusts that we highlight. So for that and other content on the sector, please visit www.edisongroup.com.